Is it fair to say that jobs and growth remain the top priority for this government based on hearing the federal budget? And do you think the government's done enough to promote job growth and to help businesses in Canada? I mean, I know you've just talked a little bit about that.
Yeah, so I think it's important to recognize that roughly half of the revenue that the federal government collects is from personal tax. And so one of the reasons why the deficit went from $6 billion last year to $54 billion this year is a big drop-off in personal tax revenue. And that big drop-off was fueled to a large extent both by rising unemployment, and as employment goes up, the tax collected from employment earnings goes down, and also relatively muted investment performance for most individuals on their savings. And so that element of personal tax revenue has gone down as well.
What about changes to income trusts? What was in the budget about that?
So there had been a few hints that was coming. Many income funds have been trying to address the mandatory, in effect mandatory conversion from their current trust-based structure to a more traditional corporate structure. And that follows from the Halloween massacre of 4 years ago that happened just exactly on Halloween night, in which income funds were given 4 years and 2 months to change over into a normal corporate structure or face a new tax regime that in some cases would result in more tax than would be payable for a corporate group. And many organizations have used that catalyst, the need to change the income fund structure, to combine with public companies that had losses carry forward. Okay. And there is, prior to today, there was nothing in the Tax Act that prohibited that kind of transaction or done in a certain way that limited that public company from continuing to apply its losses against the earnings of the income fund in the combined entity going forward. And so on the one hand, because of sort of pre-announcements about this, we're not surprised that Minister Flaherty has in effect shut down that opportunity. And so that generally speaking, most of the transactions which before today would have been possible are no longer possible. Okay. But at the very least, we're happy the transactions that have already taken place generally would qualify for grandfathering. Okay. And there's actually some interesting language around transactions that have not taken place. If the transaction is obligated to be completed, then it's eligible for the old treatment. But one common phrase that is included in documentation around a transaction that's about to take place is it could be stopped in the event of any major tax change. And there's an exception to the grandfathering if it has a clause like that, which we would view as both normal course and sort of a normal business practice to put a clause like that into any transaction before it takes place, to say that from the date that it's approved by shareholders to the date that it actually takes place, if there's a major tax change, you can stop. And so under these grandfathering rules, if there's a clause like that, then the grandfathering doesn't apply.
Okay, what about anything on stock options?
So stock options also was a bit of a policy change. And there's a couple of things. So first of all, on the positive side, there was some changes to the stock option rules as it relates to stocks that have gone down after exercise. So somebody who has a stock option, the underlying share appreciates, it's exercised at this value, and then after the share has been acquired by the individual, it falls in value. Right. And because the first type of income is an employment gain, and the second type of income is a capital loss, there was no mechanism to offset them. Okay. And so now there's some proposed rules that will allow that offset. We view that as a positive step. Good. What we are not so keen on, and what was also a change, is a change to the policy around cash-settled options. And let me elaborate on that, Peter.
Please.
When a stock option is issued to an employee, some plans allow for the employee to say, instead of issuing me the share, just give me the cash difference. So if the share is worth $100 and my exercise price is $50, just give me the $50 difference. And that's referred to as cash settlement. And it's a fairly common feature of many types of stock option plans. And when that happens, the employee, the individual who has the stock option still gets the favorable stock option treatment. But the company gets a deduction the same way they would for any kind of employment income.
Oh, okay.
And under the rules proposed today, that policy no longer exists, and that in general, the employer, the company, now has an election to make, and they can either give the benefit of the stock option in a cash settlement to the employee, or alternatively, they can say they want the deduction, and then the employee has a full income inclusion.
Interesting.
What we weren't so happy about, Peter, on that one is that the grandfathering is really, there's really no grandfathering. We would have expected in the normal course, when you have a policy change like that, that any options that have already been issued and that have an in-the-money benefit, so that they've already appreciated above the strike price of the option, in that circumstance, we would have expected that those kinds of options would have been grandfathered.
Right.
But no such luck.
No
That is not what is currently in there.
Okay.
It might be something that we or others talk further about with finance, but what's proposed right now is that any options exercised after 4 o'clock this afternoon are subject to this new regime.
Interesting.